The broadcast is now starting. All attendees are in listen-only mode.
How you doing, everyone? This is Jason Lutz and Bryan McNee. Thank you for jumping on the webinar today. Why rates?
Hello, everybody.
Hey. But Bryan, you can obviously hear me okay, and can you see my screen?
I can, and it has an extremely younger version of me on it. So
I
yes,
had to look
that's-
long and hard. I thought you would like that.
that's good. That's the one I use. I'm like a realtor. I don't ever update the photo.
That's a smart move. Okay, well, we're going to jump into this right away. Well, before we do, I want to tell just a couple of things that we have started and launched here with 1003 Magnet and MBS Authority and Rate Alert, and I want to share with you real quick. I know most of you are already familiar with it, but for those of you that are not, you definitely want to become familiar with it, which is first our chat. We now have a live member chat on the live MBS dash and the feed, so you just click it and you can see what's going on here. One thing that people have asked several times is, how do I kind of get this either out of here or be able to launch in a different window? It's just this button right here. And you can have this just on a different screen. You can move it around, and frankly, you can even close, not that I would why you would, right, Bryan? You could close this and you can still have the chat going. So it's kind of nice to be able to have this in a different window as well, and at the same time be able to close that. And then one other thing real quick, we send out a ton of emails on this for the 1003 Magnet members and MBS Authority members as well. Please just go to the App Store. It's on both Apple and Google. And download the Rate Alert app, right? So if you go to this address right here, and later I'll put it in the chat, you can see exactly what it does, but it is one cool MBS actual app, right? So you're going to get the alerts, you're able to set the sound settings, and you can go right down here and be able to see everything that you get with this app. So for the members out there, definitely download it. You get it for absolutely free. And for those of you that aren't members yet, this is a great way to start to just get kind of a taste of what it is that we have to offer at Rate Alert and MBS Authority and 1003 Magnet. One thing you want to do, by the way, guys, if you have already downloaded this, one of the first things you're going to want to do is set your alert settings, right, and the sensitivity levels when your lock desk opens. And then once you've done that, you're going to want to go to your sound settings. We have well over 100 sounds on here, so that when you have an improvement or worsening alert, you hear the sound and you don't even have to pick up your phone. You can see what's going on, or you can hear about what's going on. So definitely go to this site right here. I'm going to put it in the chat, download the app, and check it out. Bryan, I know that you're crunched for time, so let me relinquish the control to you, and you can get us with the content that everyone is waiting for here.
Okie dokie.
Let me
Thing figured out here.
I think it's all you. And by the way, if you guys have questions along the way, just put them in the question box, and I'll push those over and tell Bryan to try to address.
All right, there we go. Show my screen. Okay, folks, I think I got it. You see my fancy screen now?
I can.
All right, is it 1 or 2?
Is it 1? Oh no, it's perfect. It's just the one screen.
Okay, because you don't want to see what's on the other one, trust me. Okay, so what we want to do is talk about then versus now, what to tell realtors about rates. Okay, now we all know that rates have been going up, and what I want to kind of have us hone in our thought process is, you guys look at this right away and you know what I'm talking about, right? Because you've all been to that work-related seminar that you were forced to go to, and some idiot starts talking about this. Okay, what are they talking about? Talking about they have a jar that's a fixed size, and they've got sand, small rocks, medium-sized rocks, and large rocks. And the bottom line is, if you put the sand in first, and then all the other size rocks, it won't fit within that jar. But if you put all the big rocks in first and then pour the sand in, it all fits. The moral here is that you take care of the big problems first and then you worry about the little stuff later. And what I have found through the online chat, through emailing with our subscribers, through talking to them on the phone, is there are a lot of LOs out there, and even realtors that I'm still in communicate with. I used to train over 2,000 realtors a year for continuing education, so I'm still in contact with a lot of them. And you guys are still focused on the granular pieces of sand, and when you hear a piece of economic news come out or something that you're just used to hearing and understanding for the past 10, 20 years, you still think that that's an important thing, when in reality it's a piece of sand at this point in time. What I want to do is I just want to focus on just a couple of those bigger rocks and just wrap your head around those items, because those items are having the most influence on pricing right now. Okay, does that make sense for everybody? So what I want to do is, first, this is what we went over in January of 2015. Okay, at the beginning of this year, we had our rate mastery, and I went over everything and said, look, in 2014, we basically had a slow, gradual, steady, month-over-month improvement in mortgage-backed security prices, meaning that month-over-month, 30-year fixed rates declined and declined and declined. Okay, and I said all I did was really take an image and flip it, mirror it, and I said, here's what's going to happen in 2015. You're going to have an exact mirror image and opposite. You're going to have mortgage-backed securities gradually and slowly selling off through the rest of the year, and it means that you'll have slowly higher and higher interest rates. Okay, and that is exactly what's been happening so far this year, and it's what's going to happen for the rest of the year too. The sky is not falling. Mortgage rates are not going to 6%. You don't have to worry about this big fracture here, but it is a natural progression, and it's moving along that line. So you just have to understand that that's the way the market is going to be. And you know what? That's okay. Why is that okay? Well, let's go over a few things. First, this is a sweet chart that you can have after this webinar. I'll even give you the Excel spreadsheet with all the data and the raw chart, and you can manipulate it any way that you want. The goal here is make this your own and hand this to a realtor. Get in front of their office. What does it go over? Well, it goes over these bar lines are the existing home sales on an annualized basis. The yellow line right here is your 30-year fixed average interest rate, and this orange line right here is the unemployment rate. The sweet spot, which is the record period for home sales, okay, happened in late 2003 all the way through the beginning of 2006. And in that sweet spot, which 2005 was the biggest portion of it, the 30-year fixed interest rate on average was 5.86% all the way up to 6.76%. And in fact, it got higher than that for a period or two. But that's the range that we are in with 30-year fixed interest rates, and we have sold more homes than ever during that period of time. So what am I trying to hammer home here for you? I'm trying to hammer home that low unemployment, because during that period the average unemployment rate was about 5.1%. Right now we're at 5.4%, is more important than interest rate, provided that the interest rate is not 10, 15%, okay, obviously. But the whole business model of being in a purchase size business is you're in a sweet spot right now. You're almost there. You're almost at unemployment levels hitting those areas, and mortgage rates are starting to tick up. And when mortgage rates start to tick up, that's not a bad thing for housing. It has never been proven to be a bad thing for housing. We've got the empirical evidence for you right here. You're looking at it. So the idea here is that realtors are starting to get a little scared that rates are going up. Consumers are starting to be a little concerned that rates are going up, because why, they simply can't get 3.5% anymore, and they're concerned, which is laughable, right? But that's human nature. And so what you need to do is you need to bust this sheet out, talk to your consumers and say, well, why are you worried? You know, look, the best housing market that we've ever had was when interest rates were basically almost 2 to 3% higher than where they are right now. So realtors, Why are you concerned? Don't be concerned about the Fed raising their interest rate or this happening or that happening, because you know what? It's not going to be bad for housing. Let's look at this sheet. In fact, you can even put the realtor's face on this sheet if you wanted to, so they can hand it out to their friends or their clients. So that's one of the big boulders that I want you to have is it's okay. You know, I almost want to sing the song from Frozen. Let it go, let it go. Lower rates are here no mo. You know, that sort of thing. It's okay to have a little higher interest rate. Now, does it impact your business? Yeah, it does. And we've been talking about that the refinance share moved from 58% down to 51%, and in the next couple weeks, if not month, you'll see the refinance share below 50%. And we have historically seen that in the mortgage profession, we start losing thousands of jobs every month when the refinance share dips below 50%. And so for that reason, yes, higher interest rates are a problem for you, the LO. But they are not a problem for the housing market. And the housing market is what this year is all about. Last year was the year of the refi. This year is the year of the purchase. And as long as you've got your business models just totally snug and fit in your purchase world, you're going to do just fine. If you're doing 60-70% of your loans on a refi business right now, it's going to be a difficult adjustment for you. Okay. Now, the first thing that one of these grains of sand that people hold on to is, well, you know, the economy isn't doing well, and when the economy doesn't do well, then you know, there's no inflation and mortgage rates improve. So this is just a temporary dip in, you know, in mortgage-backed security pricing, and we're gonna you know, yields are going to drop on that 10-year. We're going to get better rates because, gosh darn it, the first quarter GDP, which came in at 0.2, why that's going to be revised down to its negative, and the second quarter, you know, the Atlanta Fed says it's going to be 0.2 and not the 3% that everybody else is projecting. Okay, you know what? That's a valid thing to think about. But what I'm trying to demonstrate for you is that we are in a fractured market for mortgage-backed securities that isn't behaving normally, and what you're expressing is a very normal, rational thought process with inflation related to bond prices. But we're not there because we're not in a free marketplace yet. Okay, what am I talking about? Well, let's say that the first quarter GDP, which is 0.2%, during the January 1st mortgage-backed security price was 101.24, and the March 31st was 102.31. So that was a really poor economy, okay? But we were trading at levels that were, what I'm trying to say is, if we drop to a negative number, mortgage-backed security prices won't go up, which is what you need for lower rates. In fact, the first quarter of 2014, when we were negative 2% GDP, we were trading almost 600 basis points worse than what we're trading right now. So mortgage rates were actually higher when we were in a negative GDP the first quarter than what we are right now. Okay, when we had a blistering 5% third quarter GDP, mortgage-backed security prices were a little better, and you would think with a really strong GDP you would have worse. So really, the conventional wisdom is that this chart would be totally flip-flopped, okay? But it's not, and we have to understand why it's not, why the change, why the trend, and it really has to deal with just the flip of sentiment among bond traders. People have been calling for the end of the bull market in bonds for a long time, and they've been wrong for a long time. But there's just simply so much momentum right now behind moving from bullish to bearish that it cannot be ignored, because now we're seeing momentum not among talking heads about what they think may or may not happen, but where the money's actually going. PIMCO, still the world's largest bond fund, even after Bill Gross exited, they cut their bond holdings, they just released this 2 days ago, from 35.3% down to 21.6%. Morgan Stanley, one of the 22 primary dealers that underwrite the 10-year Treasury sales, they expect 10-year yields to rise to 3.20 in the first quarter of 2016. I'm not saying I agree with that, but these are the people that are influencing market momentum. Bill Gross, whether you like him or don't like him, the guy has made a lot of money on bonds, and he is famously tweeting and saying that the German bond short is the short of a lifetime. And you know what? Yields on the German bond have shot up almost in direct reaction to that. Citigroup, they reported, this report just came out last week, that the 18 largest banks, you know, Wells Fargo, Bank of America, they reduced their 10-year Treasury holdings by a net $2.6 billion in the first quarter, and they had in the fourth quarter increased that by $42 billion. Where is that money going? Well, they're buying municipal bonds, $6.4 billion. So what they're doing is, and we've talked about this in the morning coffee update in the video, is bond traders are sick and tired of making nothing. Talk about a 2% yield on a 10-year Treasury, and you adjust that for inflation, and you're basically making nothing, and they're sick of making nothing. They can't exist on making nothing. The only reason they were willing to make nothing was because they were so scared of doing anything, and that's over. Risk is back on. They're putting money in other areas, which is reducing demand for a fixed supply of debt, and that's why you're starting to see the needle move finally. Okay? All right. Right. Now, part of that risk on, risk off, hey guys, look at that. I got Miyagi, wax on, wax off. Risk on, risk off. Okay. Then, very high flight to safety factory. Greece posed a risk of crushing a struggling EU economy, which could potentially spill over into other EU members, specifically Italy and Spain, and bondholders were being crushed. Now, we do have a very high probability of some type of default. In fact, I can tell you right now, we're going to have a Greek default. It's just whether or not it's called a default or not for political reasons. They're going to, like, I consider them basically in default right now because they missed a 750 million euro payment to the IMF by borrowing money from the IMF to pay the IMF. I consider that a default, but there will be some other measure of default with them. Politically at home, the Greek citizens, which elected their government specifically to get out of this, what they consider overbearing debt structure with the Troika. The Troika is a combination of Germany, the ECB, the IMF, you know, just all of those people that are just imposing their will on Greece. The citizens don't want that. Okay, they still want to be part of the EU. They just don't want to have any capital controls and be part of all this debt that a prior government in Greece racked up. They don't feel that they're responsible for it. So the ECB has already had several rounds of bad bank bond purchases. They've got their QE, which is buying up sovereign bonds. The EU economy is stronger. We're seeing across the board growth and strength. Maybe not as great as what we would like to see, but it's definitely no longer in a recession. More importantly, Germany wants them out. Prime Minister Merkel, her citizens are sick of Greece and they want them out. And she's under a lot of political pressure down home to get rid of these guys. And the bond market no longer sees this as a flight to safety over this event. You might say, oh, the bond market can't possibly have this, them leaving priced in. Yeah, they do. This whole thing, kicking the can down the road with the ECB, the IMF, etc., has been to allow everybody to reposition things so that when the eventuality of the Brexit happens, that it's not the event that it would have been a year or two ago. This is a huge factor in your pricing. Eventually, you're going to get a news story that says Greece has had some sort of default that they're not calling a default, and you're not going to see a huge spike in pricing as a result. But you were seeing spikes in pricing in 2013 and 2014 on any little hiccup or concern. So that's a big change. It's a big change. It's not something that can reverse immediately for you. And I think that what we've got here is everybody thinks that the prices that we have right now, the rates that we have right now, why that's got to flip-flop, and there's no way that we can keep getting worse and worse pricing. We've got a rebound and we've got a ricochet. No, that's not the case, guys. Now, oil prices by the end of 2014 dropped to 48 bucks a barrel. And the thought was, well, gee, that's going to be great for the economy. And my concern that I posed for you in our rate mastery at the beginning of the year was that it's going to be bad for the economy because it's going to reduce capital spending and a bunch of people are going to lose their jobs, which is what has happened. The question was, would the cheaper oil and cheaper gas pump prices equate to more retail spending to offset it? And it absolutely has not offset it. And so it is a drag on our economy. And that has helped mortgage-backed security prices. It has helped your interest rates in March and February of this year be better than they otherwise would have without cheap oil prices. But now we're seeing $60 oil. I mean, gee, that's nothing to be concerned about. $60 oil is great. But eventually when you start seeing PCE and inflationary data, all of these trend lines were comparing, well, gee, oil was at 70 and it dropped to 48. Well, now you're going to start seeing, well, oil was at 48 and it's moved up to 60, to 65, to 70. So on a month-over-month basis, you will see inflation. Now, it doesn't mean it's bad inflation. Okay, there's good inflation and bad inflation. And there's different types that the Federal Reserve looks at. But long bond traders, and I'm not talking about Jim Cramer talking about stocks on CNBC or some blogger. I'm talking about human beings that write checks. What are they willing to take risk on? When they look at something 2 years down the road, 5 years down the road, 10 years down the road, what do they think is going to happen? Because that's what they want to know. They're not buying a 30-year bond because they're going to get out of it the next day. They're not day trading bonds, okay? They want to know if they buy it, what's their exposure going to be to inflation, because inflation eats away at the real rate of return. And they're looking at this going, we don't think that oil, which has helped keep inflation low, is going to be long-term at below $50 a barrel. And so this is something to take into account. This is a then and a now. The Federal Reserve, then they were buying mortgage-backed securities. Then they were giving you calendar dates and they were giving you policy statements that said, pretty much, paraphrasing, for the next gazillion years they're going to keep rates low. Now we have removed calendar references. We have tweaked the language regarding inflation. It's no longer a 2% hard target. It is if they see that wage inflation and other forces are trending according to their own internal projections a certain way, they can begin to increase interest rates. So they've totally changed now where they were then. Then you could count on no interest rate change for a long time. Now, most bond traders have it pegged for around September. And you know what? If it doesn't happen in September, then all of a sudden everybody will be pegging it for the next month. So no longer are they, you can just assume that they're going to keep interest rates effectively at zero for an indefinite period of time. And if you're buying something like a 10-year treasury or a 30-year bond, you're not working on today's interest rate anyway. You're looking at what the interest rate's going to be 1 year, 2 year, 5 years down the road, and it's obviously not going to be zero. So it's going to go up. So what happens when the Fed does raise interest rates? Well, you know what? It's not going to be Armageddon either. Your mortgage rates aren't going to fly through the roof because, A, they don't control mortgage rates. Mortgage rates are controlled by the open market, theoretically. They were buying mortgage-backed securities, so they manipulated the open market, but now they're not. So we're having just the beginning of the return to normalcy on an open market for these things. raising an interest rate a quarter point or a half point or a full point isn't going to have a dire impact on your mortgage rates. And guess what? If they don't raise their interest rate by a quarter point or a half point or a full point this year, it's not going to help your interest rates either. Mortgage-backed securities are on that gradual trend. And how do I get back to my deal here? Here we go. You can see here, 30-year Treasury auction. It was a pretty strong auction, but you can see mortgage-backed securities have pulled back a tiny bit. We put in our morning coffee update. You would need just an absolute blockbuster in order to get you above that 200-day moving average. We didn't get it, so we're not above it. But here you go. Here's your candlestick chart. We're going to have some ups and downs, but we're going to have this gradual move towards higher and higher rates. And the word I keep saying, guys, is gradual. For some reason, if you hear the word higher rates, everybody goes Chicken Little and they get concerned. It's okay to have slightly higher rates on a month-over-month basis. And that's exactly what we're doing. Okay. Jason, is that pretty clear?
Yeah, that's good stuff. Hey, along the way, Bryan, there's been some questions, actually several questions that revolve around sort of the same theme. And if you could go back to, it was one of your first slides where you had the employment, you had interest rates, and you had housing.
Okay. Let me see here. I think, no, this is a naked picture of B. Arthur. We don't want that. Maybe we do. Here, I think, is this what you're talking about?
Yep, that's it. So several people had questions that were along the same lines, and I'm going to kind of wrap them all into one. One point, and this is from Travis and Donald and Eric, is that when you look at 2003 to 2007, wherever that kind of, like you said, sweet spot was, there was several things that were different. Today we're far more regulated, far fewer programs. That was obviously the trend of more loan programs, more people could qualify, just got progressively easier to get a loan in that time frame. It was also, they mentioned, and this is obviously true, it's a little different when rates are actually headed in the right direction, right? They're going down versus interest rates moving in the wrong direction, going away from people and headed up, which is what we're talking about today. What is your thought process? And also, I guess lastly, which no one really mentioned this, which is, the unemployment rate maybe today, supposedly, below 6%. The actual participation rate, the true unemployment rate is obviously far, far higher. So what's some of your thoughts on then versus now and sort of the not direct comparisons?
Well, I think that those are some good points. I don't have any real argument with those. There's no question that in that time period we had other loan programs that existed that don't exist now. There's no question about that. But we need to be able to have, using same data the same way over and over again. We have to be able to compare and draw some assumptions from it. For example, the unemployment rate, I think, is a fictitious piece of malarkey. I don't think it represents how the economy is doing in any way, shape, or form. But it's been calculated the exact same way for a long period of time, and so we're able to take an apple-to-apple situation and compare it. If it's flawed today, which I think it is, then it was flawed in 2005 with the same flaw. And if it was flawed in 2005, it was flawed in 1968, okay? I agree, a poor way of measuring whether or not our labor force is, what the optimization of it is. I agree with that. I think it's a joke, but since it's calculated the same way over and over, we can compare results. And whether those results are truly representative or not, at least it's the same thing that spits out. Same thing with a FICO score. You could say that the FICO score, is less predictive today than what it was before. But if it's the same relative formula, at least you have something you can compare from one point to another. So yes, I agree with that point, but it is what it is, and so that's what we're going to use for comparison. Because the concept here is that when you have more people working, there's simply more demand for housing, period. And that's the point driving there. As far as mortgage rates, actually during that period, mortgage rates were on their way up. They moved up from 5.86% to 6.76%. Okay. Looks like I got some sort of alert from my
app. That's the app.
So yeah, mortgage rates were on the way up there. That's exactly what happened, and that's what we're dealing with right now. We're dealing with slightly increasing mortgage rates. I don't even think mortgage rates will increase by the same measure during the time period. It could be a long time before we see something in the upper sixes again. Okay, but right now I think we've got the last mortgage survey on May 14th. Popped up at 3.85 is the average 30-year fixed rates. The best mortgage rates we've had of this year were on January 30th, which was the highest price ever paid for a Fannie Mae 3% coupon. On February 5th, that showed up in this interest rate because these are always a week lag. So 3.59 was the 30-year fixed rate then. For a conventional loan, you manipulate your fees and what have you, but it's a summary there. And so we've seen those rates, and what are we going from the best rates that we've had of the year, which end of January, beginning of February, we'll call that 3.6, and now we're at 3.85. That's 25 basis points in rate. That's okay. That's the type of rate, gradual rate that I think we're going to see. Maybe at the end of June, we'll see maybe 4%.
Right.
That's okay. That's okay. That's what I'm trying to say. They're going up, but they're going to be at really low levels for a long time. Okay?
Very good.
I think I addressed both issues there.
No, you did. You did. I think that's and the reality is, this is the information that we have, right? This is and it's not always going to be apples to apples, right? Things change and regulations change.
Right. You just have to do the best you can. And here's a note for all of you about the fact that we had other products back then. Those products are coming back. I absolutely know of pools that are accepting other types of loans. And these pools are created by people who have 100% skin in the game, so you don't have to worry about any other all the new rules that are going on. And there are pools that are outside Fannie and Freddie guidelines. Now, you might think originally, when you hear of that it's just pools because they're jumbo loans and are outside of Fannie and Freddie guidelines. No, they're pools for damaged credit. There are pools out there for 100% purchase loan to value, and I know right away we're going to start flooding. Who do I go to get this? You're not, because they're in-house pools that are originated by very specific entities to go into their pool. They're packaged and they're being sold, and that exists. Now the key here is that those will eventually turn into products that you can see again, okay? And it'll be gradual, but if you think you're stuck in a Fannie Freddie world with a down payment and a high credit score and that's going to be your life forever, it's going to be a big part of your life. But you will see more products hit the market because they're already out there, they're already being tested, and as long as they perform well, you're going to see more and more of those pools open up to the masses.
Perfect. I don't see any other questions that people have, and I know you have to jump off here in a minute, Brian. Did you have anything else to add, or why don't we just wrap it up?
I just want everybody let everybody know that it's a purchase world. Purchases are going to do just fine. Focus on your relationships. I don't think that myself or Schermeyer or anybody else is in a long-term float position any part of this year. I don't want to speak specifically for him, but I'm telling you that you're going to have some opportunities where you can make some pricing gains on an intraday basis. And those would really apply to people that have gotten new loans into the pipeline. But if they're not a new loan in the pipeline, and you've got a specific time horizon, you need to know that everything's not going to reverse to where you get back to 3.5%. That's just not what's going to happen. Even if the economy goes negative after the first quarter revisions, we've already shown you that right now that relationship with mortgage-backed securities isn't happening. So just be patient. Understand that the April 1st price for a mortgage-backed security was a better level than the last trade in April. The first trade in May is at a better level than what the last trade in May is going to be. The first trade in June is at a better level, is going to be at a better level than what the last trade in June is going to be. Now, it might be 20 basis points, might be 50 basis points, but it's going to be a gradual small thing. So month over month, if you've got a loan and you've got your margin built in that you're happy with, we're really just not in a spot where you should be floating for any reason. If you're incredibly technically savvy and you want to play the intraday game to pick up a few bips for one point to another, that's great. We have the tools for you to make those decisions on our live dashboard and use the heck out of them. But for the majority of you, you were rewarded all last year. You were rewarded by not doing your homework. You were rewarded for waiting. And every time you didn't lock something in, you were saved and you ended up with better pricing than what you originally were going to get because we were in this period. We're not in that period anymore. We're in this period where if you try to play the game and you're not vigilant, you could get burned. And with volumes dropping because refinances are dropping, you take it on a chin with one or two loans, and that could be a door-shutting event. So stay vigilant. Just understand the longer-term trend is for gradual rates. We're not saying that the sky is falling. We're not saying interest rates are going to go up 1% between now and June, but it's going to be gradual. You guys know that. Explain it to your realtors. Make them feel warm and fuzzy about it. And hopefully you can start building those relationships and they can send you some more referrals.
Very good. And by the way, everyone, definitely want to look at every morning at Bryan lock advice and video. As things are changing, he's consistently, changing the messaging that we should be telling our realtors and consumers about what's going on in the marketplace. Obviously, pay attention to your alerts because when you are in the position where you need to float for whatever reason, or certainly when you're taking a loan application and they don't have a property yet, and as soon as they do have a property address and you're deciding to float a little bit, try to get them a better rate, pay attention to your alerts because our alerts, both on the app and your email alerts, consistently beat lock desks by 20 to 45 minutes. And if you have any questions whatsoever about how to set up your alerts so that they actually are working for you, for your lock desk, meaning beating your lock desk, just call our customer support and they can help you really get those honed in so the system is working for you the way it should. And by the way, that number is 404-600-1003, or you just go to your MBS dash, and it's at the very bottom there. Anything else, Bryan, or are we going to wrap this up?
I think we're good. Just like we expected in our morning coffee, you mentioned about that morning coffee update. We said, hey, look, we're neutral floating. We'll make back yesterday's little loss. Right now we're up 29 basis points. Yesterday we lost 21, so we're right there. And then pretty much if you look at our intraday line chart, your 10 o'clock Eastern Standard Time pricing was 100.5, and right now we're at 100.55. So we're moving dead sideways after making up that little bit of a gain. And this 200-day moving average, I don't think we're going to close above it today. So let's hope for something good tomorrow.
All right, everyone. Thank you so much. Our next Rate Mastery webinar will really be dictated by the market, so make sure you pay attention to your emails and whatnot. If something fundamentally changes, we're definitely going to have another one, just as we've had today because the market's been so crazy lately. Thank you so much for jumping on. Tell a friend, and we'll see you next time.
All right. Thank you so much. Bye-bye.
Thanks, everyone.